Welcome to Department of Distance and Continuing Education, University of Delhi. Master of Business Administration, MBA. Semester 1, Core Course MBAFT 6104. Accounting for Managers. Lesson 8, Transfer Pricing. 8.1 Learning Objectives. After studying this chapter, students will be able to understand the basis for determining a transfer price, methods of determining transfer price, concept of goal congruence, how transfer prices can distort goal congruence, how to compare divisional performance and consider the problems in comparisons. 8.2 Introduction. Most of business enterprises throughout the world are now following a decentralized form of organizational structure whereby top management delegates daily routine nature, operations, and responsibilities to their subordinates. This leads to creation of responsibility centers or divisions within the organization. Divisional managers are solely responsible for their division's operations, returns, and profit and losses, though each division aims towards achieving its own individual goal of their profit maximization, but their goals have to be aligned with or in congruence with the organization's overall objectives known as goal congruence. A divisional manager have the authority and responsibility to control either the division's cost center, or both cost and revenue, profit center. Interdivisional transactions could involve sale purchase of goods and services, acquisition or sharing of intangibles and intellectual property rights such as trademark, copyright, patent against royalty fee or license fee, interdivisional loans against interest payments. Determining a value for interdivisional transfer of goods and services is called transfer pricing. 8.3 Significance of transfer pricing. Significance of transfer pricing is discussed as follows. 1. Helps in performance evaluation. Each division is accountable for the profit earned, which is used to evaluate its performance and motivating each divisional manager to maximize the division's profitability and improving company's overall profitability. 2. Helps in employee engagement and compensation. Usually, managers are given incentives and promotion based on performance of their division. Since transfer pricing influences profit of division, therefore, it must be priced at a fair rate by all the divisional managers to give a true and fair measurement of their performance. 3. Helps in resource allocation among divisions. Proper coordination among divisions for purchase, production, and sales helps in optimum allocation and utilization of resources, such as capacity of the machines, labor, land, and building, etc. On the basis of transfer price, decisions regarding operations can be taken, such as deciding either to produce component in-house or to purchase from outside, to expand operations or not, etc., to maximize their individual profits while also promoting goal congruence. 4. Helps in taxation and profit remittance to the head office. Since transfer pricing influence profits of MNCs having interdivisional transfers, which might affect the overall tax burden as well as the profits, because some divisions might be operating in high tax jurisdiction and some in low tax jurisdiction. 8.4 Fair value, arm's length price. The price for interdivisional transfer should be fair, reasonable, and competitive enough as if divisions are dealing with an outside third party independently, where both the parties are in pursuit of their own individual goals of profit maximization. Transfer price would become revenue for the supplying division, which the goods or services, and cost for the divisions which receives the goods or services. Where each division is profit center, any interdivisional transaction becomes more profit oriented, where each division strives to maximize its revenue and minimize its costs. Same as to how customers and businesses compete with each other using their bargaining power to set the price favorable to them. To deal or transact at the fair price for the divisions becomes necessary because it changes their profitability. 8.5 Transfer pricing methods. Here is a table depicting that. Market-based transfer price. In this method, transfer price is determined on the basis of market price of goods or services which are identical or similar to the goods or services transferred between the divisions. The interdivisional transfer is recorded at the market price after adjusting or deducting for any cost saved due to internal transfer such as selling and distribution expenses, commission, packaging cost, etc. Advantages. It is unbiased because demand and supply forces determine the market price. More clear and reliable compared to cost-based pricing because it cannot be manipulated by the internal managers. Objective measurement of performance of the division because the market-based pricing is competitive. Disadvantages. It might not be completely unbiased in the absence of competitive environment such as in case of distress sale or manipulative pricing strategies like price rigging which distorts the fairness of the market price. Market prices might fluctuate quickly to lead the data irrelevant. Sometimes market price may not be readily available for intermediate goods due to lack of active market for them. Cost-based transfer price. It is based on the cost accounting records which are prepared by internal cost accounting departments of the company. It is applied when the management wants to compare actual performance with the standard costs set within the company or as an alternative method to calculate the transfer price when market prices cannot be determined because of non-existence of comparable and relevant market. It might consider variable cost, standard cost, and full cost plus profit markup. Advantages. Performance can be benchmarked on the basis of internal cost budgets which are readily available within the entity. Information is comparatively more easily available to market price. Cost elements can be divided further into more subcomponents, therefore, basis for transfer pricing is more clearly defined as compared to market price, which is subjected to uncertain fluctuations in demand and supply. Disadvantages. The cost basis used can be subjective as there can be multiple alternatives of breaking and allocating the costs such as variable cost, full cost methods, etc. Different divisional managers might not simultaneously agree on which basis to be adopted to determine the transfer price as they will prefer to apply the method which met their profit targets and is most beneficial to their division. Since, in case of interdivisional transfers, cost is passed on to another division by raising invoice on the receiving division, sometimes managers of the supplying division find it beneficial for the division to minimize the cost of production by applying cost-efficient cost accounting methods to determine the transfer price. Marginal cost-based transfer price. Transfer price is the marginal cost, which is the addition to the total cost required to produce one more additional unit. Advantage. It is applied when supplying division has excess capacity in the form of idle machinery, labor, land, and factory space. It assumes that the supplying division will just recover the cost of internal transfer without any markup, while the purchasing division enjoys all the benefit of a lower price as compared to the market. Disadvantage. Since no fixed cost or markup can be charged from the purchasing division, each unit of internal sale will lead to a loss at fixed cost per unit at the supplying division. Standard cost-based transfer price. Transfer price is set on the basis of some predetermined costs based on budgets and assumptions with respect to factors of production such as capacity utilization, labor hours, etc. Any variation between the cost absorbed on the basis of standard cost and the actual cost incurred is either absorbed by the supplying unit or it can be passed on to the purchasing unit. Advantage. Performance evaluation can go in contradiction to budgeted cost targets. It facilitates better understanding of costs through variance analysis so that measures can be taken to improve performance. Disadvantage. Profit performance measurement is centralized and cannot be carried out for each individual divisions. Full cost based transfer price. Transfer price is determined on the basis of full product cost, which includes cost of production plus a share of other costs such as selling and distribution expenses, administrative expenses, research and development costs, etc. Advantage. Supplying division recovers full cost of goods transferred from the receiving division. Therefore, supplying division will not incur any loss. Disadvantage. Since no markup can be charged or internal transfers by the supplying division from the receiving division, which discourages the supplying division to supply internally. Cost plus a markup based transfer price. Transfer price is based on full product cost plus a markup, usually as a percentage of full product cost or of capital employed. Advantage. Since the supplying division makes a profit by charging a desired markup, this method encourages the supplying division to supply internally. Disadvantage. Since the transfer price under this method is near to market price, the purchasing division may bear a share of the selling expenses even though nothing is incurred for such internal transfer, which could distort the performance of purchasing division. Negotiation based transfer price. This is midway between market and cost methods. Divisional managers of the purchasing and supplying divisions independently negotiate with each other to arrive at a mutually agreed transfer price. Advantage. Managers are given full autonomy to decide whether to purchase or acquire or sell from its sister unit internally or source then from or sell to external market. Disadvantage. It requires sufficient information with respect to external market price, terms of trade, etc. Internal cost must also be considered in order to negotiate a reasonable price. 8.6. Transfer pricing and goal concurrence. Transfer pricing creates a competitiveness among divisional managers whereby they operate in the best interest of their individual performance, which leads to suboptimal utilization of resources. In such cases, transfer pricing policy must be established to ensure goal concurrence. Range of transfer price that promotes goal concurrence. Minimum transfer price by the supplying division is equal to additional outlay cost per unit plus opportunity cost per unit. Additional outlay cost is equal to marginal cost plus incidental cost incurred by the supplying division, for example, storage, transportation, packaging cost, etc. Opportunity cost is the benefit that is foregone from selling internally to the division instead of supplying externally. Maximum transfer price by the purchasing division is equal to lower of net marginal revenue and the external buy-in price. Net marginal revenue is equal to marginal revenue selling price per unit minus marginal cost to purchasing division. 8.7. Transfer pricing under different circumstances. Different capacity levels. 1. When the supplying division has excess capacity, the range for transfer pricing would be minimum transfer price is equal to marginal cost per unit. This ensures that the supplying division is able to recover at least its additional cost incurred due to interdivisional transfer. Fixed cost is a sunk cost, therefore, it is not considered. The purchasing division gets a benefit of getting the goods at a lower cost than market price. Maximum transfer price is equal to lower of net marginal revenue and the external buy-in price. 2. When the supplying division operates at full capacity, the range for transfer pricing would be minimum transfer price is equal to marginal cost per unit plus opportunity cost per unit. Since the supplying division is operating at full capacity, it has no incentive to sell the goods to the purchasing division at a price lower than the market price. If the internal order is accepted, capacity is to be diverted from external sale to internal sale. Therefore, the supplying division would additionally charge the lost contribution that could have been earned from external sales which are sacrificed. Maximum transfer price is equal to lower of net marginal revenue and the external buy-in price. Different demand levels. A supplying division fulfills the demand from 1. Internal divisions, 2. External markets, 3. Any special orders. Production level is subject to available capacity in the form of labor, number of machineries, factory area, available raw material, etc. Production cost is reduced due to economies of scale. For example, a machinery has a normal capacity of producing 10,000 units. However, production beyond 10,000 units requires the purchase of another machine requiring additional space, labor, supervisor, etc. This increases the fixed cost of the production department. Hence, production cost is dependent on economies to scale. Certain types of demand may also lead to cost savings. For example, internal sales require lower packaging and transportation costs because the product may be transferred in bulk to the purchasing division. Special orders saves selling expenses as it is the customer who approaches the company to sell the product and no broker or agent is involved in the deal. Therefore, in case of different demand categories, associated cost savings should be considered to determine the transfer price subject to general rule for minimum and maximum range of transfer price as discussed above. 8.8 Proposals for resolving transfer pricing conflict. Following system of transfer pricing can be adopted to resolve the conflict of interest between interests of individual divisions and the company and to achieve goal concurrence. Dual rate transfer pricing system. The supplying division records transfer price, inter-sale price by including a normal profit margin, thereby showing reasonable profit. The purchasing division records transfer price, inter-purchase price at marginal cost, thus recording purchases at minimum cost. This allows for better performance evaluation of each division and improves cooperation between divisions, promoting goal concurrence and reduces sub-optimization of resources. Drawbacks of dual pricing are 1. It can complicate the records due to two transfer prices, thereby requires adjustments and may result in errors in the overall records. 2. Profits reported by the divisions are only artificial and need to be used only for internal evaluations. Two-part transfer pricing system. This system is also aimed at resolving problems of distortions caused by the full cost-based transfer pricing method. Therefore, transfer price should be as follows. Transfer price is equal to marginal cost of production plus a lump sum charge, two-part to pricing. Where marginal cost component ensures recovery of additional cost of production related to the goods transferred, lump sum charge helps in the recovery of some part of the fixed cost of the supplying division. Therefore, it is beneficial for both the divisions as the supplying division can report better profitability and the purchasing division is also benefited as it can purchase at a lower rate compared to the market price. 8.9 International transfer pricing. Due to globalization, advancement in technology and dynamic business models, business enterprises are spreading their operations across countries, exploiting and reaping benefits from multiple countries. Business have benefited by following multinational business model. Multinationals' considerations for these business models are driven by many factors. Demand for their product. Availability of raw materials. For example, De Beers Group sources diamonds from Tata Group of companies in India. Availability of low-cost labor with specialized skills. India and China are the most lucrative sources for companies throughout the world. The interdivisional transactions in multinational companies could involve 1. Buying and selling of goods. 2. Provision of services. 3. Providing or sharing intangibles such as patents, copyrights, trademarks, or brands against royalty payments. 4. Providing loans against interest payments. Taxation, profit retake. Taxation, profit repart Taxation, profit repatriation, and transfer prices are major considerations for the senior management of the multinational organizations which try to maximize profits by using transfer pricing as a tool to reduce the overall tax burden. If the supplying division is operating in a high tax jurisdiction such as USA and purchasing division is operating in a zero or low tax jurisdiction such as Andorra, Cayman Islands, then the transfer price will be deliberately set lower, reflect low revenue for supplying divisions, paying high tax rate on small profits, and low cost for the purchasing division, paying low tax rate on large income, thereby paying lower taxes in totality. Similarly, supply from divisions operating in lower tax rate countries are priced higher to report higher earnings for supplying division paying low tax rate. Tax authorities of different countries check whether the interdivisional transfers between the divisions of the MNCs operating in different countries are priced at arm's length price so as to evaluate whether transfer pricing is used as a tool of base erosion and profit shifting. For understanding this, we can take the recent case of Starbucks UK subsidiary versus British authorities. Starbucks is known for their world famous coffee on which they have huge profit margins due their brand name and quality, but their tax records and income tax computations reported losses every year. Tax investigations revealed that the UK subsidiary paid its Netherlands unit, holding ownership of brand name and trade secrets, 6% of sales as royalty for intellectual property such as trademark and business processes. The tax authorities raised question whether 6% royalty is at arm's length and whether it is comparable with market terms for similar transactions between unrelated parties under uncontrolled conditions. In India, tax authorities regulate such tax avoidance measures through Section 92A to 92F of the Income Tax Act 1961. 8.10 International Transfer Pricing and Currency Management. Multinational firms or companies are often exposed to foreign exchange rate fluctuation risks, which create uncertain cash flows in corporate currency and also can misrepresent and misevaluate performance of subsidiaries operating in different countries. In case of interdivisional transfers between subsidiaries operating in different countries, when one subsidiary makes a loss due to unfavorable exchange rate movement, the other might take a profit if the movement is favorable for the later one. The organization therefore should manage its exposures to currency risks. The Treasury or Finance Department or managers of overall profit center is responsible for managing the currency risk. A multinational corporation which is fairly certain about exchange rate movement in the future always try to set transfer prices in a currency such that any currency losses arise to that subsidiary which operates in the high tax country or jurisdiction and currency profits arise to subsidiary in the country with lower tax rate. 8.11 Summary. Organizations having multinational operations or large-scale organizations are usually divided into departments or divisions which spread across countries in case of multinational corporations. Interdivisional transfers may be in the form of following transactions. Interdivisional transfers may be in the form of following transactions: sale or purchase of goods and services, royalty fee payments for providing right to use in respect of intangibles or intellectual property rights like brand name, patent, copyright, etc. Interdivisional loans against periodic interest payments. Pricing of transactions involving interdivisional transfer of goods and services between divisions or departments of the same organization is known as transfer pricing. 1. Performance evaluations of divisions in the form of profitability of divisions. 2. Motivation and compensation for divisional managers and employees Fair profit evaluation motivates employees and managers in improving their performance and increasing divisional profits for earning bonus and promotions. 3. Resource allocation. Optimum allocation of resources and decisions such as make or buy. 4. Compliance of income tax provisions and profit remittance by the divisions. Impact taxable profits of MNCs affecting the overall tax burden and the profits transferred by the divisions or subsidiary to head office or parent company. Fair value. Transfer pricing is mainly concerned with arm's length price, which states that the transfer price used for interdivisional transfer between division or subsidiaries should be fair and competent as if the divisions are transacting with a third party seeking to maximize their own profits. Transfer pricing methods and transfer pricing in different cases. Market price. Transfer price is determined on the basis of market price of goods or services identical or similar to the ones transferred between the divisions after making adjustments for any cost saved due to internal transfer between divisions such as commission, transportation, packaging cost, etc. Advantages. 1. It is unbiased. 2. It is less ambiguous. 3. It more objectively evaluates divisional performances. Disadvantages. 1. Market prices keeps on fluctuating. 2. Non-availability of market prices intermediate goods. 3. Manipulative pricing strategies in case of price rigging by business combinations. Shared profit relative to cost method. It is based on the cost incurred by each individual division, thereby depicting its value addition to the product as a proportion of total cost to determine the selling price of the product to be sold to customer. This method distributes profit based on the amount of value addition by each division to the final product in terms of cost incurred by it. Cost price method. Transfer price is determined on the basis of cost records of the organization. This method is applied where management wants to compare actual performance with the standard cost targets and also when market prices for the goods cannot be determined due to lack of active, relevant and comparable market. Advantages. 1. Comparison to standard cost or budget. 2. Easy availability of cost records and information. Disadvantages. 1. Multiple ways of analyzing costs such as variable cost, standard cost, full cost, etc. 2. Very low incentive to the lower cost of production. Variable cost. Transfer price is equal to the marginal cost required to produce one additional unit. Advantages. 1. Supplying division can use its excess capacity. 2. Purchasing division gets the benefit of a lower price as compared to the external market price, which is usually higher. Disadvantages. No fixed cost or profit markup is allowed to be charged to the purchasing division. Standard cost. Transfer price is set on the basis of some predetermined costs based on budgets and assumptions with respect to factors of productions such as capacity utilization, labor hours, etc. Advantages. 1. Performance evaluation against budgeted costs. 2. Proper variance analysis. Disadvantages. Profit performance measurement is centralized. Full cost. Transfer price is determined on the basis of full product cost, which includes cost of production plus a share of other costs such as selling and distribution expenses, administrative expenses, research and development costs, etc. Advantages. Supplying division will not show a loss. Disadvantages. Since markup cannot be charged on internal transfers, the supplying division does not record any profit on these sales. Full cost plus markup. Transfer price is based on full product cost plus a markup, usually as a percentage of full product cost or of a capital employed. Advantages. High incentive to supplying division. Disadvantages. The purchasing division may bear a share of the selling expenses. bargained or negotiated pricing. Managers of the purchasing and supplying divisions independently negotiate and arrive at a mutually agreeable transfer price for the interdivisional transfer. Advantages: independent power to decide whether to purchase or sell from its sister unit or source then from or to external market. Disadvantages: requires sufficient external information with respect to the external market price, terms of trade, etc. Internal cost information is required to be shared in order to negotiate a reasonable price which is fair for both divisions. Divisional conflict. Dual pricing. The supplying division records transfer price by including a normal profit margin, thereby showing reasonable revenue. The purchasing division records transfer price at marginal cost, thereby recording purchases at minimum cost. Advantages: allows better evaluation of each division's performance, improves cooperation between divisions, promoting goal concurrence and reduction of sub-optimization of resources. Disadvantages: complicate the records. Artificial profits can be used only for internal evaluations. Two-part pricing system. Transfer price is equal to marginal cost of production plus a lump sum charge, two-part to pricing. Lump sum charge enables the recovery of some portion of the fixed cost of the supplying division. Therefore, while the supplying division can show better profitability, the purchasing division can purchase the goods at a lower rate compared to the market price. Transfer pricing and goal concurrence. Minimum transfer price from the supplying division is equal to additional outlay cost per unit plus opportunity cost per unit, where additional outlay cost is equal to marginal cost plus incidental costs such as storage, transportation, etc. Maximum transfer price from the purchasing division is equal to net marginal revenue and the external buy-in price whichever is lower, where net marginal revenue is equal to marginal revenue, selling price per unit minus marginal cost to purchasing division. Transfer pricing different capacity levels. Excess capacity with supplying division: A. Minimum transfer price is equal to marginal cost per unit. B. Maximum transfer price is equal to net marginal revenue and the external buy-in price whichever is lower. Supplying division operates at full capacity. A. Minimum transfer price is equal to marginal cost per unit plus opportunity cost per unit. B. Maximum transfer price is equal to net marginal revenue and the external buy-in price whichever is lower. Transfer pricing decision. Different demand levels while catering to different levels of demand, any change in cost should also be accounted for to calculate transfer pricing. The general rule for minimum and maximum range of transfer price applies here too. International transfer pricing. Transfer pricing is also considered important in case of multinational companies to deal with important areas such as 1. Taxation, 2. Profit repatriation to head office. Multinational companies try to reduce overall tax burden to maximize profits by using manipulative transfer pricing tools. If the supplying division is operating in a high tax jurisdiction such as USA and purchasing division is operating in zero or low tax jurisdiction such as Andorra, Cayman Islands, then the transfer price will be deliberately set lower, reflect low revenue for supplying divisions, paying high tax rate on small profits, and low cost for the purchasing division, paying low tax rate on large income, thereby paying lower taxes in totality. Similarly, supply from divisions operating in lower tax rate countries are priced higher to report higher earnings for supplying division paying low tax rate. In case of interdivisional transfers between subsidiaries operating in different countries, MNCs try to set transfer prices in a currency such that any currency losses arise to that subsidiary which operates in the high tax country or jurisdiction, and currency profits arise to subsidiary in the country with lower tax rate. 8.12 Clause 3. Goal concurrence. Though each division aims towards achieving its own individual goal of their profit maximization, but their goals have to be aligned with or in congruence with the organization's overall objectives. transfer pricing. Determining a value for interdivisional transfer of goods and services is called transfer pricing. Thank you for listening.